Hello and welcome back, everyone. We have gotten called out on our Marvel stock once again, playing the wheel strategy. So let's go ahead and get right to it and record those transactions. So here we are in the Ameritrade paper trading account, and we had placed that 4050 call, and it expired this past Friday on the 27th. And you will see in the account summary we don't have any positions, open positions here. And over here in the watch list, you can see it dropped off here too. And so obviously the price went higher than 4050 just to kind of look at this. So Marvell had pretty much an all green week. So it went up from a low of about 40 all the way up to 44, I think is where it closed out. We're going to see what the last trading price was. Actually, we can see right here down the watch list, Marvell 44.25. So it went up a lot. So $4 it went up. But some people that are into stock appreciation might be a little upset about that because we owned it for 40 and we could have claimed the 44. Granted, that's if we sold at 44. I mean, technically they probably would have just stayed in it. So we had owned it at 44. So I mean, stocks, as you can see, go up and down. I mean, so you'd feel good when it's up here at 44 and you had some unrealized $4 gain, and then as it comes back down, you'll start getting unrealized losses. That's why we don't play the appreciation game or the depreciation game here. We play the cash flow premium game, to where we're collecting premiums no matter if it's going up or down or sideways, or we don't really care where it's going. We just want to collect the premium and dollar cost average to keep the cost basis as close to at the money as possible, so we can continue to collect cash flow from calls and puts and continue to play both sides of this stock or any stock for that matter. We do care if the stock is stable and it's not going to go down to zero and go bankrupt on us. We do care about that, but other than that, we don't really care about the stock going up or down. So let's go record those transactions in the website. All right, here we are again on the website, myatwm.com, sitting on the dashboard. We want to go to the cost basis page, go ahead and filter down positions because we have a position in Marvell. And what we need to do is we got called out of this. So if we come down to the calls, we can see it expired this past Friday on the 27th. And you can see right here the last price is 44.24, so it definitely got called out. So what we want to do is on the result, we want to say roll, or not roll the position. We got assigned. So assigned, we can go ahead and leave today's date as the assignment date. That's fine. I mean, technically, I think the assignment date would be the following Monday, which in this case would be the 30th. But for this purpose, it doesn't really matter what we put there. You can actually move it to the 30th if you want to. The assignment type is stock because we had to assign, or our shares got called out, so we basically had to sell our shares for $40.50 per share. So we sold 100 shares. The assignment price was $40.50. All right, so we're going to go ahead and click submit here. And what the submit is going to do is it's going to go ahead and create the proposed record to sell these stocks, these shares of the stock. So see, it proposed that record. So now that we've got that record, what we need to do is manually come back out here and clear. We need to clear off the stocks that we own and clear off this call because it expired. So we technically have no positions right now. All right, what we also need to do is record this transaction that occurred. So we sold to close the stock at $40.50, and we're not recording any fees in this demo account. So we sold it for $4,050, and it's a stock, so that's why this toggle is on. Go ahead and click save. All right, so now we are completely cleared out. If we come up to the summary, we'll see we have 0 shares owned, and this one's looking pretty good. We have gotten in and out of this stock. We haven't lost any money. We haven't gotten any capital appreciation, which that's pretty important for the tax conscious people out there, always worried about getting called out of their stocks because they're always worried about the capital gains. Well, if you're getting in and out of the stock at the same price you got into it, you have no capital gain. You have no capital loss, and you have no capital gain. So don't really care about tax consequences. Obviously, I'm not a tax accountant or anything like that, so definitely talk to them about this. But, I mean, last time I checked, capital gain taxes on 0 is 0. So there is no worry there. But we did collect almost $500 in premium while we're jumping in and out of this stock. We have collected $500 premium. Now this is a profit, and that would be taxable to my knowledge. And when you're dealing with premiums, I believe it's all short-term capital gains, so you'd be taxed at that rate. There's no such thing as a long-term capital gain on selling insurance, or selling option premium on stocks. Again, I'm not a tax attorney or tax accountant, so definitely check with them to be 100% sure. But yeah, just wanted to briefly cover that because I always hear about people complaining about they seem a little afraid of getting called out on their stocks, but I don't see what's to be afraid of if you're just getting in and out at your cost basis and basically having no capital gain or capital loss. So in any case, just my 2 cents on that. All right, so what do we need to do now? Well, we're completely out of this stock now. We're basically starting from scratch again. So ideally, at this point, you would either start looking for another stock to start the wheel on, or if you like this stock, and I do like this stock, we would just jump back into the wheel. Now, obviously, it just started jumping back up, from 40 to 44. So let's just go over to Ameritrade and see what we can see. We are looking to get back into a new cash secured put position to start this wheel over again. So let's go over there. All right, here we are again in Ameritrade's paper trading account, looking at the Marvell chart. And as I was saying before, this has been doing a big run up. It looks like it's been running up for almost the past couple weeks. So chances, if you're a technical analysis kind of person, it has started an uptrend, but as in any trend, up or down, it never just goes parabolic and continues going straight up. It will pull back, and then it'll probably test this area right here and then jump back up if it continues the uptrend, or might just hang out sideways. Who knows what it's going to do? But I would say, looking at this chart, just taking a random guess, which honestly that's pretty much all technical analysis is. It's a educated guess based off of probabilities of the direction it's moving in, and different indicators or whatever people are looking at. But just looking at this, I would say the chance of it pulling back, especially with having 5 or 6 green days in a row, the chances of it pulling back are pretty high in my opinion. I would think we definitely get some pullback at this point. Who knows? It could continue going higher, but chances are pretty high. 6 green days in a row, we're probably due for a red day, I would guess, because it never just stays green forever, just like it never stays red forever. But in any case, where I'm going with this is we are looking to open up a cash secured put position, so that always means we're going down. We always play at the money anyway, no matter where the stock is. I will say at some point down the road, I don't like playing this wheel strategy on stocks. I would probably say 40 to 50 is probably the top of when or where I would like to get into a stock. And the whole primary reason for that is exposure. I mean, if we're playing with a stock that's trading $80, $100, $200, whether it's a good solid stock or not, a lot of this is emotion, and that's a lot of room to go down. So, dropping 50% there on $100 stock, you would lose on paper $50, but that's a lot of dollar cost averaging to pull the price down to where you could actually sell calls on that if you own shares of that. However, on a $40 range stock or 50, if it fell 50%, you only lost $25 on paper again, but that's far easier to dollar cost average to get back to a point where you could actually make money on either side. So anyway, that's just my personal preference, my personal opinion. If you want to play the high dollar stocks, go ahead. Obviously, that's just the way I feel. And I will say that if you go too low, like I used to focus on $20 or less stocks, the problem with those that I've experienced is premiums. If that drops 50% down to the $10 range or lower, what you start running into there, the problem you run into there is, you don't have that far to fall, which is a good thing. That's a positive note, but the premiums are either low or non-existent. So you can't really play it very effectively on both sides of the wheel strategy. So I found the happy medium is somewhere between 20 to 50 is where I've found to be really decent. Now, I will admit, the higher than 50s up to the 150s, those premiums are really nice. And the cool thing about those is you can go far out as far as the strike price range. Like the deltas have premium for like $5 ranges and $10 ranges, which that's really nice. And I will admit, down in the 40s, the 30s, and the $20 stocks, those don't have $5, $10 ranges where they're still selling premium at those. So that is kind of a pro-con kind of thing. But right now, the 25 to $50 range has been working well for me. So that's what I'm sticking to for the time being. And who knows, we may, start scaling that up as time goes on. But in any case, all right, back to what is at hand. What we need to do is find a cash secured put. We've looked at the chart for a little while. Let's go over to the analyze. This coming Friday, I like to play weeklies, of course, because we don't like to we like to make premium as early and often as possible. So February 3rd is this coming Friday. Current trading price was last at 44.25, so a put at 44 is worth 112, well, in between. So that's a nickel spread, which is just the difference between the bid and the ask. So we could probably get 114 for this thing. All right, and I believe that's what we're going to stick with. So, and look at this. Something else I like to look at is the difference, if there is a difference, between what you can collect in premium on the put side versus the call side. So it looks like both of them are high. Sometimes that's not the case. Sometimes you'll have a super high premium on the put side and the call side is really low, and that's probably because the anticipation is the fact that the stock would be in a downtrend. But since this is an uptrend, it looks like it doesn't matter. Either way is paying more. I will say it's paying slightly more, but we're only talking pennies. All right. So what we want to do is put in an order for a cash secured put, and this still is defaulting to 10. We want to take it back down to 1, and the spread is a nickel, so we can go up halfway, or 2 pennies, so 114. And what we want to do is right click on this, do confirm and send. So we'll get a credit of 113.35, and again, there's the fee that I was talking about that Ameritrade charges, 65 cents. We'll go ahead and send that. And one thing, yeah, see, all of these are good for today, but that's okay, because this time I'm not going to screw up like I did last time. I'm actually going to make sure I look at it tomorrow, Monday, after it opens, to make sure we do get into this order and it doesn't just expire because it never got placed. So go ahead and send that. All right, so that order has been submitted, and we will have to wait till the market opens tomorrow morning and make sure that this fires. And basically what happens, if the same scenario happens that happened last week, what happened is the price opened so high, or opened higher than it's at now. So the premium, like we're trying to collect 114, it was worth less because the at the money had jumped up, so it was worth less. It was only worth like 90 or what, it was worth like 10 cents less. So it never executed, and the price never came back down, so it never executed, and it was only a good for day order, so it ended up expiring. What I would have done in that instance, had I seen it, is I would have canceled and replaced the order and adjusted the premium that I was looking at to a more at the market value, and then it would have executed. And, I may or may not have adjusted the strike price depending on how far the price had moved when the market opened. But in any case, that's how I would have fixed it if I would have been watching it. But I wasn't. So, in any case, that order is placed. We'll wait till tomorrow and see what happens. I want to thank you for watching. Like and subscribe if you haven't already. And go out today to myatmm.com and get your free account. Thanks, and I'll see you in the next one.